Joining us now to talk about his new book, How to Make Money in Any Market, is our dear friend and colleague, Jim Cramer of Mad Money fame. Jim, it's so great to see you, and thank you very much for taking the time out of your busy schedule to be with us here.
It's not too busy to be with you, Dom. I love the show, and I think that we're talking about all sorts of things, including individual stocks, what's going on with the market, and I'm happy to lend my hand, whatever you need.
All right, so let's talk about this book. I've got a copy in my hand right now, which, by the way, I'm going to send you to autograph right now at some point because I need an autographed copy of this. All right, so the name of the book is How to Make Money in Any Market. What exactly kind of was your muse? Why exactly this book right now? And what have you done with it, given all the years that you've had with market experience under your belt? What do you pick to put in this kind of a book?
Okay, it's a great question, and what I emphasize throughout is that the stocks that work in any market are the growth stocks, not just the classic, but also even some of the speculative. The reason I say that is because I studied all stocks from when I've been in the business for 42 years, and the ones that always come back are the growth stocks. The cyclicals do not. And I also don't want any trading. I don't believe in trading. I think you should buy and do homework. And the non-cyclicals, they're the ones that tend to be okay, the classic growth. And I found this to be the case in every decade, Dom, so that's what I'm trying to emphasize. And I think that you should own index funds and stocks. That's a novel and radical view on Wall Street.
So if you take, say, a core position of something like an index fund or a portfolio of index-type funds, and then you kind of bolt on some of those growth pieces around it to kind of give it the extra juice, what kind of factors have you looked at over time that have led you to some of that superior outperformance? We can say growth, but what exactly are the factors within growth that you are looking at specifically to help pick those stocks and those types of stocks that go into a portfolio that outperforms?
Absolutely. I'm looking for companies with scale that have had not any big degradation during any of the recessions or the slowdowns that we've had. I'm looking for companies that don't have a lot of debt. I'm looking for companies that I think we would all listen to and recognize on CNBC as companies that are in areas that are not cyclical, except for what I do say that there are groups that used to be great. The food stocks are no longer good. But I try to just tell you how to do it. I also say, look, if you don't know how to read a balance sheet, even though I have a lot of pages on how to read a balance sheet, there is ChatGPT, there's Perplexity, there's Grok, there's all these different new systems that allow you to be so much smarter than I was when I got started. And that way you can say, look, I mean, just go in and say, look, what kind of growth rate does this company have? How does the growth rate compare to the S&P? What has been the stock's performance during downturns? All those are now easy to find. And that's why I think it was worth it to say, look, in the old days, you couldn't get it. You got it now. There's true democracy on Wall Street. Don't let people tell you can't pick some stocks. Pick 5 stocks, and then the rest will be index funds. And I think that's nice to marry individual stocks because with index funds, think about what we do all day. We just have people come on and they talk about stocks, and maybe you're interested, but you can put them through the grid that I suggest and find out whether you think that they're really right for you.
Now, Jim, one of the chapters that resonated more with me, because you brought up the idea of doing your homework and kind of getting into understanding how these companies work, and you've known so many of them, brand names to even ones I've never heard of before. But it's chapter 15 in particular, Jim, and I want to read it. It's because the chapter is called The Conference Call, understanding exactly what the bigwigs are saying. And the first line in there says, when I first started emphasizing, quote unquote, buy and homework, I always stressed that you had to read the conference call transcripts. What exactly has been the takeaway for you in reading decades worth of conference call transcripts in your investing career?
All right, the chief one is what the CFO says, not what the CEO says. The CFO gives you the actual bones and gives you the forecast. A lot of people just wait and they go through what the CEO says and they start trading. Well, that's ridiculous. Stop that whole process. You're going to get it wrong. But the CFO sets the boundaries, tells you what can happen, and then you measure what the CFO says versus what you were looking for, and that's how you determine what's going to happen with the stock. And then I like to listen to the calls and try to figure out the zeitgeist of the analysts. I show you how to do that by talking about the zeitgeist of the analysts, say on an Amazon call versus a Procter call. Because if they're all kind of negative and asking tough questions, look out. It means it's going lower. But I do try to tell people, look, this is the fundament. If you want to do research, you have to do the call. If you can't even spend the time doing the call, then I really just think you have to be all index funds.